Good morning. My name is Paul Schatz, president of Heritage Capital, and I'm joined by my good friend Jim Lane. Jim,
Good morning. And I write a mostly a monthly piece, but also some interim pieces under the Substack, the Econ Realist, and the Economic Realist, excuse me. And Paul and I have known each other probably for more than 15 years now. And
I
you
think we're
know,
almost at 20.
they
We're,
might
we have,
want to
it's
they
like a
might want
marriage.
yeah, the Splash Brothers from NBA fame. You might want to call us the Bicker Brothers a little bit because we have a tendency to look at things from different perspectives and share those perspectives quite often. So we wanted to do that a little bit this morning.
Awesome. So let's dive right in and how about we talk about big picture economy, big picture market, and then we'll get a little more granular into some individual stocks.
Sure. So, I struggle right now to find some positive indicators. Um, the irony of that is always if you're finding lots and lots of negative indicators in the macro world, whether it's labor or other things that we both follow, there's always that silver lining of Fed to the rescue in this very Keynesian world that we live in. So, I may come across sometimes as kind of an uber bear, which is probably true on macroeconomic stuff, but not in particular when you're talking about individual stocks. And that's something Paul and I have been doing, going back and forth on for a long time. I just think we have, as I mentioned in my most recent letter, I think we have a very fragile economy because of our national debt. Our national debt is growing so much faster than our economy is, and I think I would be less negative on the macroeconomic prospects if we could find a way to grow our debt slower than our economic growth, and we're just not there yet.
And it's funny because I'm a glass half full, three-quarter full guy. I have this incredibly positive long-term view of our economy and the country, and stocks have this, we can call it a semi-permanent, permanent tailwind that we know over long periods of time, the S&P 500 returns somewhere between 8 and 9%, including dividends. That's what we know. And I think we take for granted that that tailwind, we think it's because of American exceptionalism, but it's really because of population growth. And we live in a capitalistic, semi-capitalistic economy and democracy. So there are clearly pockets. I think we get along so well because you see the world one way, I see it another, and we try to poke holes in each other's thesis. And that either strengthen your thesis when someone pokes holes in it, or you take a step back and say, I may have something wrong. And what's interesting is, as long as we've known each other, I always am very keenly aware when you and I both really agree on something. So we're either going to be wrong from that very second,
Right.
or which we've been, better to be lucky than good. We've gotten it right many more times than we've gotten it wrong. So I think, you're usually a little earlier than I am, but I'm usually a little early as well. And our models, I think it was Fed Day, uh, right near the last high, a number of our you know, non-leveraged, non-hyper aggressive stock market models started flashing yellow and then a few flash red. So that to me, I always take note. It's not that they're always right because they're not, but I take note because it means what I try to explain to clients is when reward outweighs risk, we attack all the time. When risk outweighs reward, we hedge, we short, we do things to protect. And when risk and reward are equal, it's a coin flip. I try to do nothing to try not to overcomplicate it. So for
Well,
me, the market went from
yeah.
super bullish, let's press the pedal to the metal, to let's ease off and let's not take new positions. And now, we've certainly raised cash and we've done a little bit of hedging.
And I think on the when reward significantly weighs risk, we have seen eye to eye on the past, and I'm seeing that right now in a couple of specific names. The one that overwhelmingly jumps out at me is CF Industries. CF Industries is a basically a fertilizer producer, mass producing fertilizers for industrial agriculture. And CF Industries, I look at things from almost a forensic accounting perspective. I don't really like to rely on management's comments and things like that. And this is a really interesting business, you know, at around $80 a share. This company has done between, I know you can drive a truck through this, but no negative years, between $4 plus and $17 plus per year in annualized free cash flow per share for the last 8 years. And most recently, over $10 a share. And
It's a lot of free cash flow.
this is an $80 stock. At the same time, by the way, the company's net debt is down more than 50%. Down. And their share count is down 20%. And it's paying a 2.5% dividend.
So why do you think the market hasn't recognized it, or isn't recognizing that?
I
And
have a really good friend who was in the one of the largest retail brokerage networks in the world for years as kind of a strategist. And when I bring up chemical fertilizer companies, he says, I've always been wrong on these. Everyone's always been wrong on these. Even the great analysts that have followed these things for decades, they've done a great job of following the financial results, but it's been very, very hard to predict how the stocks are going to do in, say, what I would call the medium term, the next 6 to 18 months. Okay. Some people would call that long term. But here's the thing about this business and the current macroeconomic environment we're in is that this business is valued right now at a level that could be taken private. Because if they weren't doing all the investing in new plants and so forth, this free cash flow could be well above $20 a share. So you're looking at something that steady state is probably trading at 4 times free cash flow. Okay. So as long as your financing costs are sub 10% to take this company private, you've got a lot of wiggle room in valuation floor. And this is what I was talking about, the time to be aggressive in super high quality, kind of non-household common names, right? This one jumps to the head of my list. And quite frankly, this morning I sold some Kraft Heinz because I think that's more of a 2026 story. And I put that capital into
CF.
into CF.
Yeah, we own CF too, for full disclosure, as you do. And I agree on a short-term basis. It's not rocket science that they've defended the $80 level. This will be the third time in the last couple of months. So, and personally, I like to buy really good stories, long-term stories that have fallen in hard times and the market's not recognizing it. Well, this certainly seems like something that qualifies. So, and I'm interested to see if they can take the stock below 80 intraday. Maybe not today, but over the next week or two, and then close it back above 80 to kind of flush out the stops and the weak-handed holders. So this one certainly looks super interesting, and I agree with you on the fertilizers. I feel like I've been burned forever on fertilizers as
Yeah, I
well.
mean, think about the names like ADM. Is it Bunge or Bungie? I forget
Yeah.
how you pronounce it. Mosaic and this one, and none of them have been like, names that people say I have to own. I just like it when the market's faltering a little bit in the short run, a high quality business like this with some secular tailwinds, by the way, because, 8 billion people on the planet. There was just an article, and I know it's anecdotal, but there was just an article in the Wall Street Journal about how in Ukraine, which is a huge agricultural economy when it's not under assault, um, they've underinvested in fertilizer and they've depleted their soil, so their production is coming off. This is a real need out there. It's a
I
little
just want to know where did you read the article about Ukrainian fertilizer
in the Wall
usage?
Street Journal. It's actually in the Wall
Really?
Street Journal. Yeah. Yeah.
I'm impressed.
I just came across it and hey, it's a reach to say, oh, that makes a stock a buy, right?
Of course,
But
right. But
but
it's such
but
a long, it's like the population of India and Mexico are
right.
increasing at geometric proportions. Doesn't make the economy great today. It makes it great over the long term.
Right. It's kind of like the nonsense argument about healthcare in the United States, that graying of America theme.
Right.
But
It's
that that
true, but
that
it's
takes
true for 30, 40 years, not for 30,
yeah,
40
yeah. And
days.
and and certain areas they're gonna create too much capacity over that 30 or 40 years, and you're never gonna get the returns that people were suggesting. So I just thought it was like a nice anecdotal connection to what this company does.
Do you look at Home Depot's report this morning?
I didn't. I only saw headlines. I didn't get a chance to look through it. I mean, obviously they're the killer app in the space. Um, uh, but I don't know anything about their valuation. My sense is that, Walmart, Home Depot, and the clear long-term, and Amazon, the clear long-term winners in retailers, um, have been accorded unusually high
Yeah.
valuations relative to historical, because it's clear that they're going to be the winners. So I don't think, going back to a CF, like in those names, it's hard for me to get excited because I don't see valuation floors, like just
Yeah.
clinical, mathematical LBO valuation floors.
And you
Uh,
never will in a Home Depot or an Am or should or you it's unlikely that you will. Again, Home Depot's the that's the gem of the industry. So long term, we know that lower rates are a tailwind, and coming out of a recession, this thing usually rips. But it also has a staying power. Like we were talking about, Schlumberger the other day, right? So
for
same
dead, by the
thing.
way.
In,
It's left for dead stock.
yeah, but it's the dominant player. In a crummy market, you're going to lose competition. In a great market, they're the dominant player. They
Yeah.
have the staying power. They have the earnings. They have the balance sheet.
They pay a
So
nice dividend for you to wait
beautiful
around.
dividend. Yep.
Yeah. Yeah, I agree. Less so than a Home Depot. I get a little bit more excited on a day like today, on something like Palo Alto Networks, PANW, because you've had this like some kind of a global cyber event. And I can't remember what the market cap of Palo Alto Networks is off the
I'm
top of
going
my
to tell you, Jim.
I want to say it's sub 300 billion.
It is 138 billion.
Yeah, yeah. So still in this market, it's hard to talk about that as like a mid cap, but relative to other techs.
Yeah, of
Um,
course.
and by the way, here's some statistics on this company that I don't think people realize. In fiscal 21, they have like a mid-year fiscal year. They did a little bit over $2 in free cash flow per share. Fiscal 22, a little bit over three. Fiscal 23 and 24, a little bit over four. And then fiscal 25, which just ended in July for them, over $5 a share. So yes, still trading at 40 times free cash flow per share. But this company is a huge business growing at double digits
And a dominant player.
and the dominant player in the space. And so, if you're not buying this when it gets beaten up on a big cyber event, which just validates the need for it.
Of
And
course.
I could be wrong, but this stock's been kind of on a long-term tear ever since um, Microsoft had the big breach issue a few years back. Because I
The
think
industry's been great. From my perspective, the top down versus bottom up, the industry's been fantastic. I mean, we own, and again, we own for full disclosure, we own Home Depot, we own Palo Alto, we own Schlumberger, and we own CF.
Yeah. So,
Yeah, this is
this
a
is
great
one, this is
long-term
one of my
thematic
largest,
story.
this is one of my largest positions. It's not cheap. It doesn't really have that valuation floor, but I accumulated this over, over the past 2 years. It's not something, I mean, if you don't own it, I would own it, at least to some degree. It's very volatile around earnings, man. They report good earnings and the stock goes down because historically they've kind of underpromised on the next quarter. Um, but
It definitely is not a Jim Lane stock because it's expensive by multiples and it has hyper growth rates. This is like one of my stocks. If when I'm looking for to press the pedal, it's not a Jim Lane stock CF and Schlumberger and Davita and all the other ones that you love, the Otis and the Downtrodden's.
yeah, I mean, but I also try to have things that are not um, highly correlated over multiple years with just broader market trends. I think there's a secular tailwind here, and so buying it at what's at a 2.5% free cash flow yield, you may not get you may not get a better chance. There's some companies like that. There's like Intuit, and some others that you know eh, eh, you know whenever they're trading at sometime someplace around 3 or 4% free cash flow yields, doesn't look that attractive relative to the 10-year. You're not going
Right.
to take these companies private, but it's about as best of a chance as you get because they can grow double digit revenue, maybe close to 20% bottom line because of operating leverage. You have to buy them at reasonable prices when you can, as long as there isn't something fundamentally broken. And none of the companies I talked about today, unlike where we started on the macro, unlike our U.S. government balance sheet, none of these companies are fragile, right? They've got lots of wiggle room to grow. So I think that's pretty good, Paul. Anything else you want to chat on?
Why don't we end with Nvidia because
Yep.
the biggest company is going to report earnings Wednesday's close. You know, every time we get to the Nvidia earnings, I pray that it comes in a little better than expected and volatility gets sapped out. I don't like the oversized moves based on earnings. But look, the stock, I was sitting with a couple of clients yesterday and they want to talk about Nvidia. And I said, if you told me exactly what the earnings were going to be, you knew sales, you knew earnings, you knew everything about the report, I would say I feel like I have no edge. I have no idea how the stock will react. And today I say this, if the stock continues to sell off into earnings, where it's down from 210 to 180, then I would probably lean that we're going to rally out of earnings because it's somewhat baked in the cake. I would rather have it where the stock rallies to like 210 into earnings, pops on the earnings to feed the duck, sell some of it because we do own it, and our position is now too large, but it's getting smaller percentage wise because stock's going down. But I like to sell into those great earnings reports when everybody hops on board with all that dumb money comes rushing in. You have any thoughts on it?
I don't have any thoughts on it, Nvidia specifically, but this is a place where you and I totally agree. In that using liquidity to lighten up and create some dry powder, particularly in tax deferred accounts, right? Because it just, it just makes a lot of sense, and you almost know inevitably those new weak hands are going to be shaken. I think it's like shaking the at some point they're going to get shaken, like the weak fruit on the tree. Um,
Like what's happened in
uh,
Bitcoin lately.
yeah, I mean, or we've talked about it with gold and
Yep.
some other things that get overheated. So I don't know anything about Nvidia. I don't even know where they fit in the AI like food chain or supply chain. Quite frankly, I listen to it and sit there and say, man, I just don't know anything about chips or servers or anything. So for me, it's kind of like an oddity, but I do know it definitely, let's say they have a great quarter, but are trying to keep people's growth expectations in check, and and some of my favorite names get hit.
Yeah.
I'm probably gonna sell some of my more smaller positions and add to some of my big names. I think that's kind of how I use it. But
I've been using this week as a cleanup week where I had some stuff in the portfolio that I lost the reason to own it. It's been sitting there stale. So I decided to, pull the ripcord, get a little cash. Again, if Nvidia is 170 or less on earnings, I will take a good hard look at adding to a position. Home Depot today interests me. We own it. Would I top it off? We'll see how it trades during the day. But we do agree on that. I don't like to. I'd have a very tough time buying Nvidia at $220 on a great earnings report.
yeah, I mean, to the extent that Nvidia's volatility creates something that I think is irrational in one of my names, I'm definitely going to be acutely aware of that and try to invest it. And I don't invest other people's money. I only invest my own. Um, and knock on wood, this strategy's been it's been a good 2 years.
It's been a good career, my friend.
Well,
Yeah,
we'll keep doing this. This is fun, and thanks for hosting, Paul.
my pleasure.